Lincoln Savings, Charles Keating, and the 1980s financial collapse. In the 1980s, America experienced one of the most devastating banking crises in its modern history. Hundreds of financial institutions failed, taxpayers paid billions, and a political scandal shook Washington. At the center of it all stood one man, Charles Keating, and his institution, Lincoln Savings and Loan. This is the story of greed, deregulation, high-risk investments, and the collapse that became a symbol of the savings and loan crisis. To understand Lincoln Savings, we must first understand what savings and loan institutions were. Savings and loan associations, often called S&LS, were community-based banks. Their purpose was simple: collect deposits from local customers and provide home mortgages. For decades, they operated conservatively. But in the late 1970s and early 1980s, economic turbulence changed everything. High inflation, rising interest rates, financial deregulation. New laws gave S&Ls greater freedom to invest in riskier ventures beyond traditional home loans. For some institutions, this was opportunity. For others, it became temptation. Charles Keating was a charismatic businessman and developer. He took control of Lincoln Savings and Loan in 1984. Unlike traditional bankers, Keating saw Lincoln as a vehicle for aggressive growth. Under his leadership, Lincoln began moving away from conservative mortgage lending. Instead, it poured money into high-risk real estate ventures and speculative investments. At the same time, Lincoln aggressively sold subordinated bonds to thousands of small investors. Many of those investors were elderly customers who believed they were purchasing safe bank products. But these bonds were not federally insured deposits. They were risky securities tied directly to Lincoln's financial health. Behind the scenes, Lincoln Savings was deeply exposed to unstable real estate projects. As property markets softened, losses mounted. Regulators began raising concerns about Lincoln's practices. Federal examiners warned that the institution was engaging in unsafe and unsound activities. He denied wrongdoing. He accused regulators of harassment, and he turned to political connections. Keating had donated heavily to political campaigns. 5 U.S. senators, later known as the Keating Five, intervened with regulators after receiving campaign contributions from Keating and his associates. Although the senators denied improper influence, the optics were damaging. The scandal raised serious questions about political interference and financial oversight. It became one of the most controversial political episodes of the late 1980s. Meanwhile, Lincoln's financial position deteriorated further. By 1989, the situation was unsustainable. Lincoln Savings collapsed. The federal government seized the institution. More than 20,000 investors lost approximately $250 million in bond investments. Taxpayers ultimately absorbed billions in costs as part of the broader savings and loan bailout. Across the country, over 1,000 S&Ls failed during the crisis. The total cost to taxpayers exceeded $100 billion. Lincoln Savings became one of the most notorious examples. Investigations revealed widespread mismanagement and risky speculation. Prosecutors charged Charles Keating with fraud and racketeering. In 1991, he was convicted on federal charges related to fraud and sentenced to prison. Although some convictions were later overturned on appeal, Keating ultimately served time behind bars. His name became permanently linked to the S&L crisis. The savings and loan crisis forced major reforms. Congress created the Resolution Trust Corporation to manage failed institutions and recover assets. Regulatory oversight was strengthened. Capital requirements were tightened. The crisis exposed the dangers of deregulation without adequate supervision. It showed how aggressive risk-taking, when combined with weak oversight, could destabilize the financial system. But beyond the numbers and policies were real human consequences. Retirees lost life savings. Communities saw local institutions disappear. Trust in the banking system eroded. For many Americans, Lincoln Savings represented betrayal. They believed they were investing in a safe institution. Instead, they were funding speculative ventures they never understood. The story of Charles Keating is not simply about one executive. It reflects a broader era of financial excess in the 1980s, an era marked by rapid deregulation, speculative real estate booms, and political entanglement. Lincoln Savings became a symbol, not just of bank failure, but of systemic vulnerability. When oversight weakens, when political pressure interferes with regulation, when institutions chase short-term profits over long-term stability, the consequences can ripple through an entire economy. The savings and loan crisis eventually subsided, markets stabilized, reforms were enacted, but the lessons endured, because financial crises rarely begin with collapse. They begin with small compromises, gradual risk expansion, regulatory hesitation, and confidence that growth will continue forever. Lincoln Savings did not fall overnight. It grew rapidly, fueled by optimism and leverage, but beneath the surface, instability was building. When the downturn came, it exposed the fragile foundation. The savings and loan crisis became a warning for future generations, a reminder that financial innovation without accountability can carry enormous risk, and that when institutions fail, the cost is often borne not by executives, but by ordinary people. Charles Keating's legacy remains controversial. To some, he was a symbol of corporate greed. To others, a product of a deregulated era that encouraged risk-taking. But history remembers Lincoln Savings as one of the defining collapses of the 1980s, a case study in financial mismanagement, political scandal, and systemic failure. Because in finance, as in history, the patterns repeat. When safeguards weaken, when profit outruns prudence, when influence outweighs oversight, crisis becomes inevitable, and the consequences can last for decades. But the collapse of Lincoln Savings was not an isolated disaster. It was part of a much larger financial storm. Throughout the 1980s, savings and loan institutions across the United States were facing mounting pressure. Rising interest rates had already weakened their traditional mortgage business model. When deregulation allowed them to pursue new investment opportunities, many executives embraced aggressive strategies they were never properly prepared to manage. Real estate speculation became widespread. Commercial developments, luxury projects, land deals. Billions were poured into ventures that looked profitable during boom years. But many of these investments were funded with federally insured deposits. In simple terms, institutions were gambling with money protected by taxpayers. Lincoln Savings was one of the most visible examples of this transformation. Under Charles Keating's leadership, Lincoln shifted heavily into commercial real estate and risky bond sales. The institution's balance sheet appeared strong on paper, but much of its apparent strength relied on inflated valuations and speculative projections. When regulators from the Federal Home Loan Bank Board began investigating, they identified serious concerns. They warned that Lincoln was exposed to excessive risk. They questioned whether bond sales to elderly investors were misleading, but enforcement was slow and political pressure complicated matters. The Keating Five controversy intensified public outrage. 5 United States senators, Alan Cranston, Dennis DeConcini, John Glenn, John McCain, and Donald Regal, met with federal regulators after receiving substantial campaign contributions linked to Keating. Although no criminal charges were filed against the senators, the episode created a perception that political influence may have delayed regulatory action. Public confidence suffered. The scandal blurred the line between financial misconduct and political ethics. It raised uncomfortable questions. Were regulators hesitant because of political pressure? Did campaign donations buy access or protection? The answers were debated for years. Meanwhile, the broader savings and loan industry was collapsing at alarming speed. By the late 1980s, failures were occurring almost weekly. Depositors were protected through federal insurance, but that protection came at enormous cost. The federal government stepped in with a massive bailout effort. The Resolution Trust Corporation was created in 1989 to manage and liquidate failed S&Ls. It became one of the largest financial cleanup operations in American history. Assets were sold, properties were auctioned, loans were written off. The total taxpayer Burden eventually exceeded $120 billion. Lincoln Savings alone cost taxpayers approximately $3 billion. For many Americans, the crisis became a symbol of unchecked risk and weak oversight. Unlike traditional bank robberies or dramatic corporate collapses, the S&L crisis unfolded gradually. It was complex. It involved accounting rules, capital ratios, regulatory gaps, and financial engineering, but the consequences were very real. Communities lost local lenders, employees lost jobs, investors lost retirement savings, and taxpayers absorbed the cost. Charles Keating maintained for years that he had been unfairly targeted. He argued that regulators misunderstood his business model. He portrayed himself as a victim of changing economic conditions. But prosecutors painted a different picture. They described a pattern of deception, misleading investors, disguising risk, and using political influence to delay accountability. Court proceedings stretched over years. Some convictions were overturned on appeal due to procedural issues. Yet Keating ultimately served prison time for fraud-related charges in both federal and state cases. His downfall became one of the defining corporate prosecutions of the era. The savings and loan crisis left a lasting impact on financial regulation. Capital requirements were strengthened, supervisory authority was reorganized, stricter accounting standards were introduced. It was a reminder that deregulation without safeguards can create systemic vulnerability. But history shows that reforms often follow crisis rather than prevent it. The S&L collapse foreshadowed future financial turmoil. In the decades that followed, the United States would again confront large-scale financial instability, most notably during the 2008 financial crisis. Different instruments, different markets, but familiar patterns: rapid expansion, rising leverage, overconfidence, weak oversight, and eventual collapse. Lincoln Savings became more than a failed bank. It became a cautionary tale taught in business schools and regulatory training programs, a case study in how aggressive growth, political influence, and inadequate supervision can intersect. It demonstrated how financial institutions can drift far from their original mission. Savings and loans were created to support homeownership and community development. By the 1980s, some had transformed into speculative investment vehicles. The shift happened gradually, and when the reckoning came, it was severe. Today, the savings and loan crisis is sometimes overshadowed by more recent financial scandals, but its lessons remain relevant. Financial systems depend on trust. Depositors trust institutions, investors trust disclosures, citizens trust regulators. When that trust erodes, stability weakens. Lincoln Savings did not collapse because of a single bad investment. It collapsed because risk was layered upon risk, because oversight lagged behind ambition, because warning signs were ignored. A product of deregulation, or an architect of deception? Perhaps he was both, but what is undeniable is the scale of impact. Tens of thousands of investors affected, billions in losses, and a crisis that reshaped American financial policy. The savings and loan crisis reminds us that financial systems are not self-correcting. They require transparency, accountability, and independent oversight. When political influence interferes with regulation, when institutions prioritize growth over prudence, when complex financial products are sold as safe investments, the risk of collapse increases. And when collapse arrives, it rarely stops at one institution, it spreads. Lincoln Savings was emblematic of its era, a symbol of ambition unchecked by caution, a warning written not only in headlines, but in lost savings and public cost. Because in finance, as history repeatedly shows, excess eventually meets reality, and when it does, the consequences can echo for generations.